What's up, guys? Mike Sharp here. This is Sharp Investing, and I just wanted to be transparent about what I'm doing with my portfolio. I have cut my exposure to 80%. I've removed the 20% that I usually have in trades. Actually, not all of it. There's still a little bit left from the gold and silver trades, but probably more like 15% cash, and the rest will come off in certain scenarios if I need to. But what I'll do here is I'll just explain what I've done, why I've done it, and some of the macro that I'm looking at, which has made me. There's some stuff in here that has made me a little bit worried that the market is wobbling or potentially has some downside to it. And I just really wanted to book some profits, right? Like I've had a good year. My portfolio is up almost 30%, 29.5% versus 15.7 on the S&P. So I'm having a good year, and I just don't want those profits to evaporate, especially since it's been going up basically in a straight line since the Trump bottom in April. And I think, eventually there's going to be a correction just to try and relieve some of the buying pressure here, because there might not be any buyers left, right? But there's a few things I'm looking at in terms of the market, which I'll go into. Now, first off, what I've done, I had stuff like Zeta and DLO, which are, I think, quite good companies that I'm researching. I did have positions in both of them, but I've liquidated them on Friday last week, basically at the close. And I've also cut my gold trades by about 75%, and I've liquidated the other trades that I had that were just kind of like just chart based, stuff like NRG, which is the ticker symbol, and ARC. I even bought ARC, which didn't do well, but that's gone now too. And like I said, those are not fundamental plays; they were technical plays. So I'm just basically positioning a bit more defensively. The last time I did this was in April. If you look here, actually March. I started in March. This is the S&P 500. I originally, as soon as the S&P broke the 200-day moving average, that's usually a technical concern moment if it does that. And I did sell some into that move. Came back here and tested the 200-day and got rejected, which was confirmation that the trend was probably down. And then Trump, this gap here, that's Trump's Liberation Day. I did short some futures for the S&P and NASDAQ. Basically like 5 minutes after he showed his stupid chart with all the dumb tariff rates that made no sense. And then we had this actually a pretty quick move down to the bottom. And I did sell more of my position. I was actually over 20% cash at that point, just because I didn't want to ride the whole thing down in case it turned into a bloodbath. Now, I'm okay with taking a hit on these if I'm wrong. Basically said, if I'm wrong and the market reverses, gets back above the 200-day and holds there, then I can just get back in, right? So, which is actually what happened here in May. I re-added once it tested this 200-day and came back off. So I went back in 100%, or actually more than 100%, because I was levered on on some precious metal stuff, which I did videos on. So then we go back to today. We've broken the 50-day moving average today. I did sell on Friday, which was there above the 50-day, but this chart looks a little bit tired to me. I think it's starting to wobble. We have a high here. It didn't make a new high there, which is the first sign of concern. Now it's broken the 50, so there's some technical indicators that it might be going down. There are some other things that I'm looking at. The breadth is very weak these days. On October 20th, they had one of the worst breadth days since the 90s, which means that most of the stocks in the S&P were down, even though the market was up, which shows us that the market is being driven by a few companies and a few themes that are holding the thing up, but under the hood, it's not that healthy, because a lot of companies are not, their price action is not great. So breadth is pretty weak. And then we've seen all these earnings late October through mid-November. And I think that the earnings are another canary in the coal mine. There's a lot of decent earnings coming out, and the stock prices are not following through. Like there's no buying. There's sometimes initial buying pressure. Like let's look at Robinhood. Robinhood did well on earnings. and boom, no follow through, right? We're seeing it collapse here, right? So there's a lot of moves like that. I think there was another one here. Oh, that wasn't an earnings move. But anyway, there's a lot of stuff going on that makes me think that there's a bit of a problem. Zeta was one of the ones. That's the one I own. Good earnings. Boom, you can see popped on earnings, really good earnings, and boom, no follow through. DLO, decent earnings. So I bought there and then I sold on Friday. Decent earnings, and boom, no follow through. Right? So there's a lot of that stuff going on in the market. And if we look even further below the hood, all these crazy uranium, AI, like what are the other ones? Quantum, all this stuff is starting to show weakness, right? So like Oklo is a pretty key one. That is a big spike. That was me putting short candidates somewhere up here and I didn't do it. But that is a weak looking chart. Boom, high, couldn't make a new high and boom, it's falling apart, right? This is a uranium stock, same kind of chart. Also didn't short it. This is a, again, short candidate, didn't do it. Now these might bounce back, but these are weak. When you get a high and then there's no pushback up to the high again, like you want the momentum to keep going if you're a momentum investor. And these are starting to break down. MicroStrategy, that's that Michael Saylor stock, really looks terrible, right? That's one of the bubbles that looks like it's falling apart, which is the crypto bubble. Iran, this is another one that doesn't look as bad, but that looks terrible. Boom, big spike up. Looks like it should have followed through and just collapsed. Retest there, gone. Like these look really bad to me. And so I wonder if the bubble is bursting at this point, or at least the air is coming out of it. And I wonder if the guys who got in 2021 or 2020, these new investors or new traders maybe, and a lot of them got burned in 2022 when that bubble popped, and maybe they're learning from that. Maybe a lot of these people are going, I don't want to hold the bag here, so I'm just going to take my profits and get out, because a lot of these bubbly situations just don't look like they're falling through. Like space stocks, let's look at Rocket Lab. Well, Rocket Lab doesn't look good either. Right, that didn't hold. It doesn't look terrible. ASTS, another favorite. Same kind of charts, right? These are big spike ups and big fall. That's a 40% drop from the top just in a month, right? So a lot of this stuff doesn't look great. Now, one of the other things going on is that the PE ratio is quite high. If you look at the market, it is pretty high, just over 30% currently. But if we look under the hood, this might not be as bad as it looks. These Yardeni guys, Yardeni Research, did some pretty good work here. Basically, they're taking they're breaking this S&P 500 up between the Mag 7 and the non-Mag 7. If we look here, this is the blue line's a Mag 7. It's at 30% of the S&P 500 market cap, right? So it's whatever the Mag 7 do is going to really influence the overall market, right? So if we say, okay, well, the 30% or the 30 PE of the market, is that really what the market looks like, right? So here's some forward PEs, right? So the red line here is the Mag 7. The forward PE is 30, right? And these might be deserved because these are phenomenal businesses with huge moats, huge profit margins, and huge growth rates, right? Maybe they're actually worth this much money. They have been historically, right? As long as they can keep growing cash flows at this high clip, it might be worth it because you have those massive moats. This is the S&P forward PE. It's high. It's at over 22 there, 22.6. But if you remove the Mag 7, it's just around 20, which is not cheap, but it's not outrageously expensive either, right? Especially if you're trying to hide your money from the depreciation of all these fiat currencies. Like it's not actually terrible because you have earnings growth. And if you just hold cash, your money could evaporate, right? So check this out. It's pretty interesting. Those are price to sales. That's not actually that useful, but You can see, yeah, again, the market cap percentage of the Mag 7 is just going up and up. And my main point here is that maybe the high PE that we're seeing in the market in general is not actually as bad as it seems. I don't think it's comparable to 1999. 1999, the market structure was very different. The quality of the businesses in the S&P 500 was lower. They had lower profit margins. They had lower growth rates. And it was not dominated by, such these huge high quality companies. So I just think a straight comparison to 1999, which I see a lot of comparisons these days, might not make as much sense as it seems. It might be a little bit too simplistic. But it is expensive, right? It's not cheap. This market's not cheap, but it might be in the range of reasonableness. Anyway, I don't want to risk it. Is the main thing for me. I've taken 20% out, or sorry, 15% out. It could be 20% shortly here, and yeah. So if we go over to gold, let's just take gold. Look at gold for a bit. I've done a few videos on these. Does this one show? Okay, so it kind of shows where I bought. I bought initially here. What's that? Around 2,100. I did a video there. Did a video there. That was around 3,500 because it was breaking out again. Now we can see what's happened here is that it's been unable to hit a new high, right? So that shows that the buying momentum is reducing. Now this might just be a consolidation period. You might get some kind of a flag formation like that, and then it kind of pops out to the top, or you get a flag like that, and it comes down here and pops out. Those are normal consolidation patterns. But I'm just waiting to see what it ends up looking like. Now silver, it looks a little bit better actually. I don't want the one with all my writing on it. Basically, you have two highs here. Usually if you get a horizontal support or resistance, that is actually constructive on whatever side that's on. So if you see it on the bottom, it's usually bearish. On the top, that could be bullish, right? So I basically taken my positions off, and I'm just waiting to see how this plays out. I want to see how these patterns look. I want to see how some of the macro stuff plays out, because there's macro stuff that could really impact gold and silver. Now, speaking of macro, let's talk about it. So there's some bullish stuff, bearish stuff. I'll talk about the bullish stuff first, and then bearish stuff, you can make up your own mind. Now, one of the things that's going on here that I think is bullish is that there's a lot of weakness in economies around the world. Now, why is that bullish? Well, because you're starting to see stimulus, right? You're starting to see rates come down, and in particular, like direct stimulus. Japan is printing, looks like they're going to print 110 billion in stimulus. China is also stimulating. Europe's probably going to start stimulating. Trump's talking about 2K dividends to low and medium income people. That would be very stimulative to the markets and to the economy, because as we know, lower income people spend their money. They don't just stick it in the stock market or in bonds or something, which doesn't actually help the GDP that much. So, those could be really stimulative. Also, the Fed has stopped their balance sheet reduction. So this is maybe not a bullish move, but it's neutral. It's going from bearish to neutral. Instead of running off mortgage-backed securities and treasuries, now they're going to run off mortgage-backed securities. Not great for the housing market still, because that'll keep rates higher than they would be if they were just neutral or buying. But the money they get from their mortgage-backed securities running off is going to be invested in treasuries, which means they are now buying treasuries. And so that is good for the bond market. And it sounds to me like they're probably monetizing these huge deficits that the US government is producing. So now we have potentially have a coordinated central bank and government in the US, which is probably good for stocks long term. It's good for gold, and it's terrible if you're a middle class person earning a wage, because it's going to mean inflation. This is like emerging market stuff, and we're probably past the point of no return here. So, could be good and bad all at the same time, depending on who you are. Bearish side, now there's some bearish arguments on macro as well. The last meeting, the Fed pivoted hawkish. Powell basically said, don't count on a rate cut in December, and the market was counting on it, right? So I think a lot of this move in the markets is the market adjusting to that information, right? So that might be this move that we're seeing here, where the market's getting weaker because the market needs lower rates in order to keep going. Now it's possible they pause and they just start up again in January. Maybe they're just delaying, or maybe they're actually going to pause. Now on the other side, if they actually cut in December, I think that would be quite a bullish surprise for the market, and you might see a spike here when they meet, if they actually cut. Now the other bearish thing is I'm not convinced that Trump can actually force these rate cuts that he wants. Now he wants rates down, let's say 2%, but the way they work at the Fed is that they are it's a vote system. It's not a dictatorship where the Fed chair just gets to do what he wants, right? So even if Trump gets his guy in May, which he will, Powell's term is up, doesn't necessarily mean rates are going to come down. There are people on the Fed board that don't like Trump and don't want the interference. They're supposed to be separate from the government, and it's possible they don't get the votes needed. Right now, Trump is trying to stack the deck. He's taking Lisa Cook to court, trying to fire her. We'll find out in next year if they can actually do that. In which case, if Trump can just start firing them, he gets to appoint the new members. If he can start firing people with these bullshit causes that he's got, then you have a different situation. But if he can't fire her, then it's possible that he doesn't actually get what he wants next year and might have to find another way to do it. So long story short, not 100% sure that he's going to be able to get what he wants. He usually gets what he wants, but I just can't see a guaranteed path there. Now, the only other thing that can happen that I'm going to talk about is that these Trump tariffs could be reversed. There's a hearing, there's a ruling in December whether they are illegal, and he'll have to refund all the money. Now, you could argue that that's bullish, right? More money going back into the hands of all the businesses that paid it. I don't know. It could also mean that he can't do his $2,000 dividend, right, which would be bearish. So I don't actually know how that works. If they do get invalidated, then I think the US dollar is probably going up, which generally is actually bad for asset markets. Who knows? So the point is that it's murky and I can't really see it super clearly. I could see it going in one way or the other, and just kind of want to take some of the risk off and book some of the profits. So that's the bottom line here. I'm just taking some profits. I want to book in the good year that I've had, and then I'll just let my investments run. Stoneco, Vistry, what have I got? Stoneco, Vistry, Caspi, Newbank, Full House, and Flow Traders, and I got some App 11 in there too. That's, I'm willing to hold those through the cycles, and I do want to make sure that I have cash. If this market melts down, I want to buy some more of those and maybe some other stocks if they melt down. Worst case scenario for me is the market collapses and I don't have any cash. I could sell Flow because it's probably the one that's going to do the best in those scenarios, but you never know, right? And I should also add that, I don't know if I said it already, but my portfolio construction is quite different from what it was in 2021. 2021, I went defensive as well, but I had a lot more stable names and less exposure to wild things like emerging markets. And if you look at my portfolio now, and so in 2020, sorry, I should finish that thought. So in 2021, I went defensive. I missed the last 4 to 6 months of that big bubble that they had, but it helped me in 2022 when the bear market came. I actually beat the market by about 10% in that year because I was so defensively positioned. This time, if it goes into a bear market, I don't know if I'm going to hold up that well. Like stuff like Stoneco, Caspi, Newbank, App 11, I think all this stuff gets annihilated in a bear market. Those are emerging markets companies, which everyone will just sell in a bear market. And then App 11, it's pretty expensive right now. It's a great business, but it's probably expensive. It probably gets cut in half. Even stuff like Vistry and full house could lose 60% of their value if everyone's just selling stocks. Now, those are all good businesses, and that's why I own them. But you know, I can't count on being able to sell any of them in a bear market to buy other stuff because they'll all probably get destroyed. So that's sort of just a cautionary tale, is that my portfolio is pretty high beta, I think, and might get nuked in a bear market. So anyway, I hope you got something from that. I do think that there are some signs that there's some weakness under the hood, and you know, be careful out there. All right, thanks. Catch you in the next video.